Hello. Welcome, listeners and market participants, to KBRA's European Credit Podcast, Conversations in European Credit. I am Gordon Kerr, Head of European Research at KBRA, and today I am joined by my colleague, Kali Sirugudi, from our European RMBS team here. Today, we will be covering the topic of the buy-to-let lending market in the UK, where we have been active in rating transactions and analyzing the market. The particular focus of our discussion surrounds a recently published report that explores the refinancing risk associated with buy-to-let mortgages in the UK. The UK's buy-to-let market has undergone significant policy changes in the last several years. Economic difficulties from rising interest rates, slowing house price growth, and an increased cost of living affecting tenants have created a challenging landscape for landlords, especially those looking to remortgage in this new environment. In addition, regulators have altered policies to try and ensure higher quality buy-to-let mortgage origination, including energy efficiency improvements for older properties. So, let's set the stage for our listeners first with a little background on the state of the market. Kali, buy-to-let lending has historically been a growing market within the UK, and in particular has been a large part of the UK securitization market, as a number of lenders make use of the securitization market for funding. So how has the buy-to-let lending market developed in the past several years?
Thank you, Gordon. And good morning, good afternoon to the listeners. The buy-to-let lending post-GFC has increased progressively in response to the demand for purchase of buy-to-let properties by landlords. And this was driven by the relatively low interest rates, the rising rents, and which both put together offered attractive yields to buy-to-let landlords. Now, this period saw a lot more individuals entering the buy-to-let sector given the attractive yields. Changes to the treatment of the buy-to-let mortgage interest rate tax relief and higher stamp duty charges introduced in 2017 dampened the growth in the buy-to-let property purchases and hence advances. Buy-to-let lending surged in 2015 to about £14 billion, just before these changes were progressively introduced. Now, since then, the buy-to-let lending settled to an average of about 12.5% of the total residential lending in the last 5 years. However, we now see the lending to the buy-to-let sector slow down, driven by the increase in interest rates, which started in Q4 of 2021, which has made buy-to-let mortgage debt less affordable and has driven the yields down.
So the market appears to be continuing to face pressure from the lender side of the market. Short-term fixed-rate borrowing was traditionally popular with landlords while interest rates were low and lending was readily available. For example, short-term fixed rates in 2016 accounted for approximately 60% of the loans. How has the market developed with regards to fixed and floating and relative interest rates?
In general, mortgage borrowing in the UK is typically for short-term fixed-rate products. And as you say, Gordon, the fixed-rate product consumption by borrowers accounted for about 60% of all lending in 2016. The 2017 KBRA guidelines on affordability expected the assessment of affordability to stress for higher interest rate, typically charged once the lower fixed rate period ended. Now, before the recent trend of the increase in interest rates, as I said, since Q4 2021, lenders would stress the DSCR for buy-to-let loans at a higher interest rate of 5.5%. And this was particularly for loans with a fixed rate period up to 5 years, as required by the KBRA guidelines. For mortgage products with a fixed rate period of 5 years or above, most UK lenders would not stress the affordability at the higher interest rate. This would mean a higher loan eligibility for the 5-year or a longer fixed rate tenure product. So most borrowers in the UK borrowed using the 5-year product, and increasingly so. And this trend further strengthened in 2021 in anticipation of the increase in interest rates.
So, as you highlighted there, central bank policy rates have been rising to fight inflation, and so too have mortgage rates. Rates for mortgages in the UK have now reached above 6%, and those for buy-to-let have been on this upward trajectory for rapidly for the last year or so. So, how are these impacting landlords, and how has the rental market reacted?
So as you said, rates have been rising rapidly to high levels, reaching over 6%, with many landlords finding their fixed rate period on the mortgage expiring in 2023 or 24. They will face the possibility of either remortgaging or continuing to pay the loan on the reversionary rate. Now, some landlords may choose to temporarily move onto expensive reversionary rates or remortgage for a shorter 2-year teaser period in anticipation of lower interest rates in the future, assuming they can manage the temporarily elevated costs. Although this option comes with its own risk, as the future path of interest rates is unpredictable. Remortgaging at current higher fixed rate means a higher interest cost, and this will have a negative impact on the DSCR for the loan. Remortgage applications will therefore be limited to a lower loan amount than the current outstanding amount of the loan for the DSCR to meet the minimum standards of a lender, assuming no change in rental income. In this scenario, buy-to-let borrowers may need to consider bringing in additional funds to enable remortgaging at the lower loan amount found eligible by the lenders. As landlords' costs increase, they can look to increase rents and pass through these costs to the tenant. However, while residential rents across the UK are increasing, landlords are not typically able to increase the rent on a property until the end of the tenancy agreement. KBRA expects rents may continue to rise to the extent they remain sufficiently affordable, although the already heightened cost of living may be a limiting factor as tenants may struggle to accept higher rates.
Thank you. Now, turning to one of the major headlines that the news has focused on recently is the impact all this will have on house prices. So, how will the impact on homeowners be felt across the buy-to-let spectrum?
Yes, the recent hikes have weakened affordability for house purchases. Now, this has resulted in a housing market slowdown, with house prices declining about 4% from their peak at the national level. Now, recent high LTV originations may be adversely affected by a fall in property prices, which in turn may affect the ability to remortgage at the end of the fixed rate period. However, for older loans, this is partially mitigated by the house price appreciation observed in the last few years. That's about 22% since the beginning of the COVID period. Apartments are a meaningful concentration in buy-to-let mortgages, and given the higher observed price declines for this property type, the remortgage risk could be relatively worse. Borrowers could be forced to bring in more equity to enable remortgaging.
Thank you for that assessment of the current state of the market. Now let's dig into some interesting work that you and your colleagues have done on the impact of the current state of affairs on the buy-to-let lending market and the risks to refinancing. First, can you explain quickly the background of your analysis?
So KBRA sought to estimate potential remortgage risk in existing buy-to-let loans. To achieve this, KBRA analyzed a data set of about 19,435 buy-to-let loans, aggregating £4.1 billion in volume, which are part of various RMBS transactions in the UK, primarily sourced through RMBS, which is a repository of most RMBS transactions in the UK. Now, KBRA's analysis focused on the remortgage challenge for loans ending their fixed period in 2023 through 25, which includes 8,319 loans and a value of £1.7 billion, which was about 41.8% of the KBRA dataset. For this analysis, we considered any loan where we calculate a DSCR less than 1.25 times at the assumed remortgage rate of 5.5%, or with an indexed LTV of higher than 75%, to have heightened remortgage risk. Further, of all loans with heightened remortgage risk, KBRA assessed their vulnerability to arrears based on a DSCR of less than 1 times, calculated at an assumed reversionary rate of 10%. For buy-to-let loans, the DSCR threshold of 1.25 times is typically the minimum DSCR criteria applied by lenders in the UK, and the maximum allowed LTV by most lenders is 75%. The evaluation of remortgage risk calculates the DSCR for loans by assuming, as I said, the remortgage rate of 5.5% for a fixed rate buy-to-let loan, and it considers the indexed annual rent reported in the pool tapes. The annual rent was indexed to Q1 2023 using the index of private housing rental prices, and KBRA applied an additional haircut of 5% to the index valuations when calculating the LTV to account for a potential decline in house prices.
That is very interesting, Kelly, and a comprehensive data set with given all those filters as well. So what out of the outcome of this, what were your initial conclusions?
So it's indeed interesting. So 5% of the analyzed KBRA data set will look to remortgage at the end of their fixed rate period in Q3 2023. Now, I focus this to make it easier for the audience to understand how we assessed, which I've already described, but what conclusions did we see from specific cohorts in that data set. So the 5% of the analyzed KBRA data set, which I mentioned, which have their fixed rate period ending in Q3 2023, have a weighted average DSCR of 2.1 times at origination and a stressed DSCR of 1.5 times at a remortgage interest rate of 5.5%. So of the loans ending their fixed period in that quarter, 54% are above the thresholds for remortgage risk, indicating positive remortgage likelihood. However, 40% will have a DSCR of less than 1.25 times, and the remaining 7% will have their haircut indexed LTV greater than 75%. KBRA therefore estimates this aggregate 46% of loans ending their fixed rate period in that quarter to have a higher remortgage risk factor. The KBRA also determines that the loans with a fixed rate end date falling in Q1 2024 to have the highest proportion challenged for a remortgage at 59%. The aggregate proportion with a higher remortgage risk factor in 2023 through 25 is estimated at 49%, or 20.3% of the KBRA dataset. So we also assessed, in addition to the risk of remortgaging, what the risk of delinquency for loans would be. So of the loans with higher remortgage risk factor during the remortgage period, KBRA calculated a new DSCR based on the reversionary rate, assumed at 10%, and the rental income index to Q1 2023. The loans with a new DSCR below 1 time or below 100% are considered the most susceptible to fall into delinquency. For example, in Q3 2023 cohort, 43.1% of the loans exiting their fixed rate period in that quarter show a higher risk of falling into arrears. The aggregate proportion of loans with a higher remortgage risk factor through 2023 to 25 and a higher delinquency risk is estimated at 19.5% of the KBRA dataset. At the regional level, the risk of delinquency is the highest in London at 12% of the KBRA dataset, followed by the Southeast region, estimated at 2.9%. On the same basis, the proportion of loans to individual borrowers as at risk of higher delinquency is estimated at 11.5% of the loans, while the same for portfolio borrowers is 5.9%. The proportion of loans with a higher remortgage risk factor and or a higher risk delinquency can be lower to the extent landlords can increase rents to at least cover the monthly repayment amount on their mortgage, while tenants can absorb that increase. Additionally, the low indexed LTV for KBRA dataset indicates minimal losses in the event a borrower either defaults or exits the buy-to-let sector. Borrowers with a higher remortgage risk factor may choose to exit the buy-to-let sector by selling their properties to pay off their respective loans. The haircut indexed LTV for the loans that end their fixed rate period in 2023 through 25 is low at a weighted average of 65%. The majority of these properties have gained from house price appreciation, which averaged 22% in the UK over the last 5 years. Therefore, in the eventuality of a property sale, and even at moderately lower prices than currently prevalent, a borrower in most cases should be able to repay the entire loan amount outstanding, including accrued interest and other costs. So KBRA views the low LTVs for the loans as a key mitigant to remortgage risk and the potential losses for the loans with higher remortgage risk factor.
Thank you very much, Kelly. Even though you sort of think that refinancing risk is a big challenge for landlords, there are some other challenges that are facing borrowers ahead. Maybe you can quickly outline a few of those that face landlords in the near future.
Certainly, Gordon. So these challenges arise from some of the changes which we see in the UK jurisdiction, which affect buy-to-let landlords. And the least of these are the recently introduced Renters Reform Bill. Second, certain tax implications in 2023 to 24 for buy-to-let landlords, which are to a degree adverse on their income and yields from the buy-to-let sector. And the third is the expectation of the introduction of the minimum energy efficiency standards regulation for rented homes. So to elaborate on the first of these changes is the Renters Reform Bill, which was introduced in the Parliament on 17th May 2023, aiming to bring meaningful changes to the rental landscape. The bill is expected to improve tenants' rights while detailing a landlord's obligations under a rent agreement. Significant proposals in the bill include ending fixed-term tenancies and replacement by periodic tenancies without an end date, allowing tenancies to end by giving 2 months' notice, abolishing Section 21 no-fault evictions, and establishing a new ombudsman to resolve rental disputes. So the bill, while driving behavioral changes for both landlords and tenants, may change the economics for a buy-to-let for a landlord. The second topic was on the tax implications, and we find some of these changes, as I said, to adversely affect the economics of a buy-to-let landlord and their involvement in the buy-to-let sector in the UK. For example, the corporation taxes will rise to 25% from 19% for those with profits above £50,000. The tax-free dividend allowance was reduced to £1,000 from £2,000. Thirdly, under the wear and tear allowance, landlords were allowed to claim an annual tax deduction based on 10% of their rental income for fully furnished properties, which has now been replaced by the replacement of domestic items relief. Under this relief, landlords are now only able to claim for the actual cost of replacing furnishings. And of course, the stamp duty threshold was raised to £250,000 until March 2025. So these, as I said, these tax implications will mean less profitability and may actually force some of the existing buy-to-let landlords out of the sector. Next is about the energy efficiency ratings. A recent UK regulation, first established in 2021 to tackle energy poverty for privately rented homes, requires properties with new tenancies to have a minimum energy performance certificate rating of C by 2025. By 2028, all tenancies, including existing tenancies, will also be required to have a minimum EPC rating of C. Although the share of privately rented properties with an EPC rating of C or higher has increased to 44.8% in 2022 from 29.3% in 2017, there is still a relatively high percentage of homes that will require upgrades. KBRA expects a majority of properties with an EPC rating of D should be able to upgrade to an EPC rating of C at a reasonable cost. However, those lower than D may incur substantial costs. For properties with an EPC rating of D or lower, KBRA expects landlords may choose to divest over investing in upgrades based on one, a lender's ability to finance such home improvements weighed against profitability, and two, the potential net gain in property valuation and or rents from improvements. Additional costs could mean releveraging, which may lead to an additional DSCR burden unless the borrower can offset this with an increase in rent on account of lower energy costs. If borrowers choose not to upgrade low-rated EPC properties, the risk to lenders is that these properties may not achieve the desired sale price upon repossession, which may result in a loss to lenders.
Thank you very much, Kali. And on the EPC topic, we recently published a report taking the other view in terms of the impact it has on greening the property market and the prospect for improvement in those older properties. And that was focused on the region of Ireland. So please go to kbra.com and check that out. In summary, it is KBRA's view that the current environment will affect individual buy-to-let borrowers more adversely than portfolio borrowers who may be able to better manage their leverage levels and mitigate low DSCRs on individual properties as a part of diversified property portfolios. Some landlords will likely sell buy-to-let properties and exit the sector altogether over the changing financing and tax environment. Others may choose to continue on their current mortgage loan, albeit at high reversionary rates, aiming to raise rents to compensate for the increased costs. KBRA expects that the issue of LTV to be a limited factor for remortgaging, restricting to a small subset of borrowers, given the quantum of house price decline so far in comparison to the DSCR demands. The performance of a buy-to-let loan in the current environment depends not only on the landlord's ability to increase rents, but also on the tenant's resilience to absorb payment increases amid today's high cost of living. Notwithstanding the higher remortgaging risk factor for loans with lower DSCRs, indexed LTVs for buy-to-let loans are currently at moderate levels. Therefore, as highlighted by Kali and his colleagues, we expect losses to be minimal, barring a significant decline in home prices. You can find greater detail in the recently published report on our website, kbra.com, and make sure you are registered to receive our latest commentaries and have subscribed to our podcast. And of course, give us a nice review. Thank you very much for listening. We look forward to bringing you more conversations in European credit. Best of luck to you all out there as we continue to combat the challenges ahead.